Hello there. So you're thinking about investing in the UK's next big thing through the Enterprise Investment Scheme, or EIS. It can be an absolutely fantastic way to invest, but it comes with some pretty strict rules. That's why we've teamed up with the experts at My Tax Accountant to bring you this guide. We're going to break down one of the most critical parts of the whole scheme, the EIS 3-year rule. All right, let's paint a picture. Just imagine, you find what you think is the next game-changing UK startup. You put your money in, and for doing that, the government literally gives you a massive tax break. We're talking a huge chunk of your investment back. It's an incredible incentive, right? It's designed to get people like you and me backing the UK's most exciting businesses.
But here's the big what if. You know, the one that probably keeps a few investors up at night. What if that company gets sold, say 2.5 years down the line, and it's sold for a loss? Suddenly, that amazing tax break you got feels, well, pretty shaky. What happens now? Do you have to pay it all back? Is there anything you can do to make it less painful? That's the million-pound question, isn't it?
And that's exactly what we're going to get into today. We'll start with the 3-year rule itself, then look at the tax benefits you're aiming for. We'll cover what happens when the clock stops early, look at some key exceptions to the rule, and then, this is the important bit, talk about strategic selling and loss relief. And finally, we'll wrap up with how to get expert advice. Okay, first up, the EIS 3-year rule. Honestly, you can think of this as the golden rule for tax relief. It's the absolute cornerstone of the whole scheme.
So here it is in black and white. To keep your main tax reliefs, you have to hold on to those shares for at least 3 years. Simple enough, right? Well, hang on. Look at that last bit. Whichever is later. This is the part that catches so many people out. If you invest in a company before it's even started trading, your 3-year countdown doesn't start ticking when you get the shares. Oh no, it starts when the business actually begins its qualifying trade. It's a tiny detail, but trust me, it can make a massive difference.
Right, so let's talk about unlocking your tax benefits. Why does this 3-year rule matter so much? Well, let's look at what you stand to gain or lose. First up, the big one, a massive 30% upfront income tax relief. So for every pound you invest, up to £1 million a year, you can slash 30p right off your income tax bill. It's incredible. And get this, if you're investing in a super innovative company, what they call a knowledge-intensive company, that limit doubles to a whopping £2 million a year. It's a fantastic, immediate thank you from the government for supporting growth. And then there's this, the long-term prize. If you hold those shares for the full 3 years and the company absolutely smashes it, you pay 0 capital gains tax on your profits. Nothing. The company's value could go up tenfold, and every single penny of that profit is yours tax-free. It's what makes EIS potentially a life-changing investment if you get it right.
And there's another great benefit, this time for estate planning. After you've held the shares for just 2 years, not 3, they can become 100% exempt from inheritance tax. It's a really powerful way to pass on wealth. So while we're focused on the 3-year rule today, it's definitely worth keeping this 2-year perk in the back of your mind.
Okay, so we know the rules and the rewards. But theory is one thing, right? Let's make this real. Let's look at what happens when the clock stops early. To do that, I want to introduce you to Sarah. So meet Sarah. She's a freelance graphic designer in London. Back in July 2025, she invests £50,000 into a cool new tech startup. She does her tax return and, brilliant, gets £15,000 knocked off her tax bill. For a while, everything's looking good. The company's growing, but then December 2027 rolls around. An offer comes in to buy the company. The catch? The offer values her stake at just £30,000. And worse, it's only 2.5 years after she invested. She's 6 months short of that magic 3-year finish line. What a nightmare. And this is where Sarah comes face to face with a word that no investor wants to hear: clawback. It sounds pretty nasty, and honestly, it is. A clawback is just what it sounds like: HMRC demanding you repay the tax relief you've already had. By selling early, Sarah has triggered this, and she's now on the hook to pay back some, or maybe even all, of that £15,000. So what does she actually have to do? Well, you can't just ignore it. You have to be proactive. First, you must write to HMRC and tell them you've sold the shares early. They'll then work out how much tax you need to repay and send you an official bill, which is called an assessment. Then, of course, you have to pay it. It sounds a bit scary, I know, but it's a clear process. Okay, this all sounds pretty brutal.
So you're probably wondering, are there any get-out clauses, any exceptions to the rule? Well, yes, there are, but they're very specific. So here they are. For example, if the investor passes away, the rule doesn't apply. Same if you transfer the shares to your spouse or civil partner, the clock keeps ticking. And this one is really important. If the company just completely fails and your shares are worthless, you don't have to repay the relief. In fact, that's when you can claim something called loss relief, which we're about to get to. But for a simple sale like Sarah's, unfortunately, none of these exceptions help her. Now, let's talk about strategic selling and loss relief. And honestly, this next part is absolutely crucial. This is where many investors miss a trick. So stay with me, because this is how you can turn a bad situation into something, well, a bit better. Let's see how Sarah can find a silver lining here.
Okay, this is the official rule, straight from the horse's mouth at gov.uk. It basically says that when you work out your loss, you can't use the full amount you originally paid for the shares. First, you have to take away any of the tax relief that you didn't have to pay back. I know, it sounds a bit complicated, but let's walk through it with Sarah's example. It'll make perfect sense.
All right, let's break this down step by step. Her sale price, the disposal proceeds, is £30,000. Easy. Her original cost was $50,000. Now for the clever part. How much tax relief does she pay back? It's not the whole $15,000. The clawback is capped at 30% of what she got from the sale. So 30% of her £30,000 proceeds is £9,000. That's the amount she has to repay. So if she got $15,000 of relief originally and she's paying back $9,000, that means she gets to keep $6,000 of it. That's the income tax relief not withdrawn. We subtract that $6,000 from her original cost of $50,000, that gives us an adjusted cost of £44,000. So to work out the loss, it's the sale price of $30,000 minus the adjusted cost of $44,000, which gives her an allowable loss of £14,000.
And here's the pro tip. This is the real silver lining. That £14,000 loss is special. It's not just a capital loss you have to save for future profits. Sarah can actually offset that entire loss against her income, either for this tax year or the last one. Now think about that. If she's a higher rate taxpayer on 40%, that £14,000 loss could knock £5,600 straight off her income tax bill. That's a huge help and really softens the blow of the original investment loss.
So, as you can probably tell by now, getting your head around the EIS rules, especially when things go wrong, can be seriously complex. This is where getting some expert advice is so important. So let's just quickly recap the main points. First, that 3-year rule is everything when it comes to keeping your income and capital gains tax relief. Second, if you sell early, you will face a clawback of that relief. And third, and this is the good news, even if you sell at a loss, you can claim that super valuable loss relief against your income.
Look, the stakes are high with this stuff. The details really, really matter. Trying to figure out a clawback calculation or a loss relief claim by yourself isn't just stressful, you could end up making a very expensive mistake. The good news is, you don't have to do it alone. Now, just a quick but very important note. The information we've gone through today is for general guidance. Everyone's situation is different, so it shouldn't be relied on to make financial decisions. Before you do anything, you must consult with a professional, like the tax experts at My Tax Accountant. If you want expert personal advice on your EIS investments or really any other tax issues, the team at My Tax Accountant are the people to talk to. You can give them a call on 0208 570 8531 or drop them an email at info@mytaxaccountant.co.uk. For a deeper dive, check out the full article on their blog. The link is on your screen. And of course, please do subscribe to their YouTube channel for more expert guides just like this. Thanks so much for joining me.